Have you ever felt like you're running on a financial treadmill? You're working hard, saving up, but somehow getting ahead feels tougher than it used to be. Well, a big part of that feeling might have to do with something we hear about all the time, but maybe don't fully grasp: interest rates. For the past couple of years, we've been on a wild ride with rates climbing higher and higher. The big question on everyone's mind is, what if they don't come down? What does a world of persistently high interest rates look like for you and your money, not just today, but into 2025 and beyond? Let's break it down. Think of interest rates as the cost of money. When you borrow money, the interest rate is the extra you pay for that privilege. When you save money, it's the reward the bank pays you for letting them use your cash. For a long time, money was cheap. Interest rates were near zero, which encouraged a lot of borrowing and spending. But then, inflation crashed the party. To cool down the overheating economy and bring prices back under control, central banks, like the Federal Reserve in the US, had one major tool: hiking interest rates. They made borrowing more expensive to slow everything down. The hope was always that this would be a temporary fix, a little bit of short-term pain for long-term gain. But what if this isn't short-term? What if 2025 rolls around and we're still living in this high-rate environment? This scenario would fundamentally change the game for our finances. It affects everything, from the dream of buying a home, to the car you drive, to the money you have saved for retirement. Understanding this new reality is the first step to not just surviving, but actually thriving in it. So, let's pull back the curtain and explore the real-world impact of high interest rates on your wallet, your investments, and your biggest life decisions in the coming year. First up, the big one: buying a house. For many, this is the cornerstone of the classic dream. But with high interest rates, that dream can feel like it's drifting further away. This massive increase in monthly payments has a huge ripple effect. It prices a lot of first-time homebuyers right out of the market. Your borrowing power shrinks dramatically. The amount a bank is willing to lend you is based on your ability to make those monthly payments. So, with higher rates, the loan you qualify for gets smaller, forcing you to either look for a cheaper home or come up with a much larger down payment. This creates a tough situation. While high rates might eventually cool down soaring home prices, it's a slow process. In the meantime, the affordability crisis gets worse. Renting for longer becomes the only option for many, which makes it even harder to save up that all-important down payment. So if you're planning to buy in 2025, you'll need to be extra strategic, potentially looking at smaller homes, different neighborhoods, or focusing intensely on boosting your down payment savings. But it's not just mortgages. High interest rates send shockwaves through all forms of debt. Think about your credit cards. Most credit cards have variable interest rates, meaning they're directly tied to the rates set by the central bank. When the Fed raises rates, your credit card's APR, or annual percentage rate, usually follows suit, and fast. Suddenly, that balance you've been carrying gets a lot more expensive. A balance that might have cost you $50 a month in interest could now be costing you $75 or more. Over a year, that really adds up, making it much harder to pay off your debt. It's like trying to run up an escalator that's moving down. The same logic applies to car loans and personal loans. If you need to finance a new car in 2025, you can expect to pay significantly more in interest over the life of the loan compared to a few years ago. This might mean settling for a more affordable model, buying used instead of new, or holding onto your current car for a bit longer. The era of cheap money made it easy to finance big purchases. The era of expensive money forces us to be much more deliberate and cautious. The key takeaway for 2025 is that managing and reducing debt becomes priority number one. High-interest debt, especially on credit cards, can become a serious drain on your financial health, and creating a plan to tackle it aggressively will be more important than ever. Okay, so we've talked about the challenges, and it might sound a little gloomy. But here's the silver lining, the other side of the coin. Savers finally get their day in the sun. For over a decade, savers were punished. You'd put your hard-earned money in a standard savings account and be rewarded with a measly 0.01% interest. You were literally losing purchasing power to inflation. But in a high-interest rate world, saving becomes attractive again. Suddenly, High-yield savings accounts, money market accounts, and certificates of deposit, or CDs, are offering attractive returns. We're talking 4%, 5%, or even more. This is a game changer. Your emergency fund, which should always be in a safe and accessible place, can now actually work for you, generating real, meaningful income. Let's say you have $10,000 saved for emergencies. At 0.01%, you'd earn a pathetic $1 in interest over a year. But in a high-yield account earning 5%, you'd make $500. That's a real return that helps your savings keep pace with, or even beat, inflation. For 2025, the message is clear. Don't let your cash sit idle in a traditional low-yield account. Shop around. Online banks, in particular, often offer the most competitive rates on high-yield savings. It's one of the easiest financial wins you can score in this environment. Making your cash work for you is no longer a fantasy. It's a real, achievable strategy. Now let's venture into the world of investing and the stock market. This is where things get a bit more complex. High interest rates can be a headwind for the stock market for a few key reasons. First, they make it more expensive for companies to borrow money to expand, innovate, and hire. This can slow down their growth and, in turn, hurt their stock price. Second, as we just discussed, safe investments like high-yield savings accounts and government bonds become more attractive. When you can get a guaranteed 5% return from a bond, the risky proposition of the stock market looks a little less appealing to some investors. This is what's known as the risk-free rate. As it goes up, it pulls money out of riskier assets like stocks. You might see more volatility. Growth stocks, particularly in the tech sector, which often rely on cheap borrowing to fuel their rapid expansion, can be hit especially hard. On the other hand, more established, dividend-paying companies in sectors like consumer staples or utilities might hold up better. These are often called value stocks. They're like the tortoises in the race, slow and steady. But remember, timing the market is a fool's errand. The worst thing you can do is panic sell when the market is down. For most long-term investors, the strategy for 2025 remains the same. Stick to your plan. Continue to invest consistently, a strategy known as dollar-cost averaging. This allows you to buy more shares when prices are low and fewer when they are high. A high-rate environment is a test of an investor's discipline, and those who stay the course are often the ones who come out ahead in the long run. So, how do we put all of this together and build a financial game plan for 2025? It's not about making drastic, panicked moves. It's about making smart, strategic adjustments. Let's call it the high-rate action plan. First, and most importantly, attack high-interest debt. Make a list of all your debts, from credit cards to personal loans, and order them by interest rate. Focus all your extra firepower on paying down the one with the highest rate first, while making minimum payments on the others. This is the avalanche method, and it will save you the most money in interest. Second, make your savings work for you. If your emergency fund is earning next to nothing, move it to a high-yield savings account. It's a simple process that usually takes just a few minutes online, and it's the easiest way to benefit from the current environment. Third, if you're a home buyer, recalibrate your expectations. Work on improving your credit score to get the best possible rate, focus on saving a larger down payment, and be realistic about what you can afford based on the monthly payment, not just the home's sticker price. Patience will be your greatest asset. And fourth, for investors, stay disciplined. Don't let short-term market noise derail your long-term goals. Ensure your portfolio is diversified and aligned with your risk tolerance. A high-rate environment might be a good time to review your portfolio with a financial advisor to make sure it's still on track. It's about playing defense with your debt and offense with your savings. Living in a world with persistently high interest rates requires a shift in mindset. The habits that worked when money was cheap won't serve you as well now. This new era rewards discipline, patience, and strategic planning. It rewards savers over spenders and prudent borrowers over reckless ones. It can feel challenging, especially when you see the cost of a mortgage or the interest on your credit card statement. But it also presents new opportunities. The chance to earn a real return on your savings is something we haven't seen in a very long time. By understanding the mechanics of how these rates affect your life, from your debts to your savings and investments, you can move from a place of anxiety to a position of control. You can build a financial plan that's resilient and prepared for this new reality. The rules of the game may have changed, but winning is still possible. It just requires a new playbook. I hope this gives you a clearer picture of what a high-rate 2025 could look like for your finances.